Target's recent earnings report has sent ripples through the retail sector, raising concerns about soft consumer spending, margin pressures, and broader economic headwinds. While the company managed to beat Wall Street's fourth-quarter expectations, its weaker-than-expected first-quarter guidance has investors questioning the health of the U.S. consumer and the retail landscape at large. In this video, we'll break down Target's earnings, analyze its impact on the broader market, and discuss what it means for investors and competitors in the months ahead. Target delivered a mixed report for the fourth quarter with both positive and troubling signs for its business. On the bright side, the company exceeded Wall Street's expectations for both earnings and revenue, helped by a strong holiday shopping period. Despite concerns about consumer spending, Target saw steady foot traffic in its stores, even raising its comparable sales guidance in January. New product launches, such as its all-in-motion leggings and redesigned Auden bras, also resonated with shoppers, proving that well-timed, affordable, and trendy merchandise can still drive demand. However, there were clear warning signs in the report. Target's net income for the quarter fell to $1.10 billion, or $2.41 per share, down from $1.38 billion, or $2.98 per share, a year earlier. This 20% decline in profitability raises concerns about the company's ability to maintain margins in an increasingly competitive environment. Additionally, sales fell to $30.92 billion, a 3% year-over-year decline partly due to an extra week in the previous year's period but also indicating some softening in demand. More troubling was the fact that gross margins shrank by 0.4 percentage points, as Target leaned on higher promotional and clearance markdowns to drive sales. Perhaps the most concerning aspect of Target's report was its weak first-quarter guidance. While the company did not provide specific figures, it warned of meaningful year-over-year profit pressure in the first quarter. Target also tempered expectations for 2024, forecasting just 1% sales growth, significantly below Wall Street's 2.6% estimate. Earnings per share are expected to range between $8.80 and $9.80, which aligns closely with analyst estimates but highlights limited upside. These cautionary signals come as consumer confidence saw its biggest drop since 2021, and discretionary spending remains weak. Target's struggles are not happening in isolation, and its results could signal trouble for other retailers, particularly those that depend on discretionary spending. With consumers increasingly prioritizing essential goods over non-essential purchases, companies specializing in apparel, home goods, and electronics, such as Best Buy, Macy's, and Kohl's, could face similar headwinds. Luxury retailers may be somewhat insulated from this trend, as their customers are generally less affected by economic downturns, but mid-tier retailers that cater to price-sensitive shoppers could struggle in the coming months. The reliance on aggressive promotions to drive sales also suggests that retailers across the board may be forced into a more discount-heavy strategy, putting additional pressure on profit margins. If Target is struggling to maintain its margins despite its strong brand loyalty, other retailers may find themselves in an even more precarious position. Companies with strong pricing power, such as Nike and Lululemon, or those that benefit from bulk discounting strategies like Costco and Walmart, may fare better in this environment. While discretionary retailers face mounting challenges, grocery and essentials-focused companies could emerge as winners. Walmart, Costco, and Dollar General stand to benefit as consumers tighten their budgets and prioritize necessities. These retailers have already been gaining market share, and Target's weak guidance could indicate further shifts in spending habits. From an investment perspective, retail stocks, particularly in the consumer discretionary sector, could see increased volatility. Investors may reprice retail equities lower, anticipating weaker earnings from other companies. The performance of Walmart and Amazon in their upcoming earnings reports will be critical in determining whether Target's struggles are company-specific or part of a larger industry trend. Another looming concern is the potential impact of tariffs. Although Target briefly mentioned tariffs in its guidance, it did not specify how much they could affect profitability. If new tariffs on Chinese imports take effect, companies that rely heavily on apparel and electronics sourced from China could face rising costs. The ability to diversify supply chains or pass costs on to consumers will be a key differentiator for retailers navigating this uncertainty. So, how much of the drop is economic versus tariff-driven? While tariffs present a potential future challenge, most of Target's expected profit decline appears to be driven by economic factors. Consumer confidence has fallen sharply, with February seeing its largest decline since 2021. January's consumer spending data also showed a sharper-than-expected drop, signaling early signs of recessionary behavior. High inflation and interest rates continue to weigh on household budgets, making discretionary spending more difficult for many consumers. By contrast, tariffs remain more of a secondary risk, as no major new tariffs have been implemented yet. While future tariff policies could raise costs for imported goods, this is not the primary reason for Target's weak first-quarter outlook. At least for now, the majority of the pressure on Target's profits, likely around 70 to 80%, is coming from weaker consumer demand rather than rising supply chain costs. Despite its short-term struggles, Target is actively working to regain momentum and position itself for long-term success. The company has announced strategic partnerships with Champion and Warby Parker, which will bring exclusive loungewear collections and eyewear shop-in-shops to Target stores and online platforms. These collaborations aim to attract new customers and strengthen Target's brand positioning. However, the rollout of these initiatives is not expected until late 2025, meaning the benefits will not be immediate. Beyond partnerships, Target's success in the near term will depend on its ability to drive demand through product innovation and seasonal promotions. The company has seen positive results when offering fresh, affordable, and on-trend merchandise. Its recent wins with all-in-motion leggings and redesigned intimates suggest that if Target can maintain a steady pipeline of compelling new products, it may be able to offset some of the broader economic pressures weighing on discretionary spending. For investors and analysts, several key factors will be worth watching in the coming months. Consumer spending trends in April and May will provide insight into whether discretionary spending rebounds with warmer weather and tax refunds. The earnings reports of competitors like Walmart and Amazon will help determine whether Target's struggles are unique or part of a larger industry-wide slowdown. Macroeconomic indicators, including inflation and interest rate trends, will also be critical in assessing whether consumer confidence can recover. Target's earnings report underscores the growing challenges facing the retail sector. While the company performed well during the holiday season, its weak first-quarter outlook raises red flags about slowing consumer spending, heightened price sensitivity, and declining discretionary purchases. Retailers that depend on apparel, home goods, and other non-essential categories may face continued struggles, while grocery and discount chains could see further gains. For investors, caution is warranted in the retail space, especially for companies that lack strong pricing power or a clear competitive edge. However, those with unique product offerings, resilient business models, or a strong presence in essential categories may still find opportunities to thrive. As first-quarter earnings season unfolds, the broader retail landscape will come into sharper focus, offering more clarity on whether Target's challenges are an isolated issue or an early warning sign of deeper economic trouble ahead.